onto your seats, people. We're going to get down and dirty with the financial reports. That's probably the most exciting thing that I will say today. But look, I do believe that you will learn the power of understanding your numbers. Although it's a fairly dry topic, I can understand, I can't understate the importance of truly knowing your numbers in your business. I believe it's the key to creating a successful business. And as they say, you can manage what you measure. So as Greg said, I'm Suzanne Walker. I started ClearPath Accounting nearly 5 years ago with the vision of helping local business owners create a business that really delivers the lifestyle of their dreams. I believe that traditional accounting and taxation services, although extremely important, does not help our clients to build better lives. So at ClearPath Accounting, we offer a wide range of services. Obviously, tax and accounting services go along with that. And we get that as streamlined as possible so that it's not the focus of our business discussions. And we offer business advisory services, tax minimisation services, business planning, asset protection, succession planning, and we're actually branching out to business coaching services as well. And that's really to help our local businesses propel forward. So that's really great. So what I'll do is there is one thing I want to share with you. Hang on, it's not working. Yep, there it is. Okay, before I start, I thought I'd share a thought for the session. So the budget is not just a collection of numbers, but an expression of our values and aspirations. So hopefully we've all updated our budgets and forecasts to reflect the challenges of COVID-19. These numbers express your aspirations really for your business over the next 12 months. Now it's time to make sure that you understand, monitor, and measure what you've set what you've set in these budgets and forecasts. This webinar is about demystifying the most common reports in your business, and on a weekly, monthly, quarterly, or annual basis, so that you're in control of your business performance. Turn my video off because I like to just, you can just see the screen. Okay, so over the next 60 minutes, we'll cover the importance of knowing your numbers, an overview of the different type of reports you should be producing, the difference between profit and cash, the key drivers. Sorry, my clicker is not working, so I'll use my mouse. Sorry. The key drivers of business value, how to protect your assets, how to adopt best practice. So we'll outline some potential steps for you to take to make sure you truly understand your numbers. And please make sure you take plenty of notes today. Some of what we talk about might sound like foreign language to you. That's what I like to call accountantese language. So send through your questions at any time during the webinar for us to answer near the end. You'll also, or should have received already, and if you haven't, we can send that to you, a guide to understanding your financial reports. So that contains detailed explanation of today's content, and it shows how your reports can tell a story about your business. And as Greg said, if you have any questions, just type them via the chat box for us and we can address those at the end of the webinar. So knowing your numbers is vital because it allows you to interpret your reports and know if you're on track to achieve your business goals set in your business plan or your business recovery plan. So here are my top 6 reasons why you need to know your numbers. They tell a story of your business, allowing you to interpret the results of your business activity. This helps you identify symptoms and root causes. So for example, a decline in gross profit is a symptom of many root causes, such as inefficient pricing, job rework, poor purchasing, and high wastage. So knowing your numbers will enable you to spot early warning signs of a potential issue. For example, monitoring how long it takes customers to pay you allows you to quickly respond to that and make some changes there to increase your cash. So areas of strength, areas of strength and weaknesses will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. Understanding your numbers also means you have reliable financial information to base your decisions on. And finally, knowledge is power, and that's a big one for me. The more you know about your business, the better your business decisions will be. So we'll be reviewing each of these key reports to help you understand what you can learn from them. So typically a financial statement report that your accountant prepares for you will include your trading account, your profit and loss, balance sheet, statement of changes in equity, depreciation schedule, and your shareholder current account. So we'll work through an example to show key learnings and things to look out for in your reports. We'll use the same fictitious company, Foods Co, as an example. The first report is your trading account, which tracks your sales, variable costs, and gross profit to calculate the return you're achieving before deducting any fixed overhead costs. Your gross profit percentage indicates whether your margins are improving or deteriorating. You might like to track your results across different divisions or product lines using multiple trading accounts. For example, if you have regional locations, having a trading account for each location allows you to track how each is performing. The trading account items are an area we look closely at with clients because we know small adjustments to these items can actually have a really large impact on overall results. And I'll demonstrate that for you now. So this is an example of food manufacturing company's trading account, so Food Co. As you can see, they had sales of over $1 million and cost of sales of $318,000, giving them a gross surplus from trading of just under $700,000. The direct costs here were just over $450,000. So their gross surplus or gross profit, which is different to net profit, we'll tackle that a bit later on, was $248,749 to be exact. So that gives the gross profit percentage of 24%. So don't forget, gross profit is the figure before deducting any overhead costs like your rent, advertising, and other business expenses. Now, let's say the company undertakes coaching with their accountant and implements strategies to increase their, customer retention rate, and that results in a 10% increase in sales. They also work with their accountant to review their inventory processes and reduce their cost of sales by 5% here. So they're not big adjustments. That's what I want to point out here. They're not massive adjustments. And they can renegotiate the contract with their delivery provider, resulting also in a 5% saving in direct cost there. As a result of those changes, their gross surplus has increased by $140,000, and their gross profit percentage has increased from 24% to 35%. So that's really what we're talking about. Those small differences in three categories in this trading account can actually bring a lot of extra money in. So understanding your trading account allows you to identify areas where small improvements can have a big impact on profitability in your business. So your profit and loss statement, also known as your income statement, shows all your earnings and costs over the year and tracks the overall performance of your business. So it matches your income and expenses for the period with adjustments made for timing difference. For example, you might have sales that have been made, but money has not yet been received. So there's accounts receivable in there. The sales are still counted in your profit and loss at that time that the sale was made. So it's important to remember that profit is not the same as cash. The profit shown in your profit and loss statement includes non-cash expenses such as depreciation, and you must also ensure that you have sufficient profit to cover extra cash costs like principal, loan repayments, asset purchases, and private drawings. Your profit and loss statement provides a framework to benchmark your business results by using percentages or comparisons between years to compare your business performance to similar businesses in your industry, which can be really quite handy. Businesses are generally valued using a multiplier of earnings, so your profit and loss statement is a fundamental driver to the value of your business. The higher your earnings, the higher your business value. So in this example of a profit and loss statement using the same fictitious company, Foods Co, we've taken the gross surplus from the trading account, so you can see that on the top line there. And we've listed all the operating expenses. So, and then right down the bottom here, it's followed by the owner's remuneration here. Okay, so second last figure there, to calculate the net surplus or loss in this situation. Now, as you can see, the company is currently trading at a loss of $113,000. Obviously, this is not sustainable. So let's say the company undertakes a review of their expenses with their accountant again and identifies potential savings to be made to their insurance and their rent. They contact an insurance broker and their landlord and negotiate 5% reduction for both of those expenses. They've now saved $597 for insurance and just under $3,000 for rent. But you will notice, sorry, morning having time. You will notice the accountancy fees went up. So remember in the previous example, the company had engaged a wonderful accountant to coach them and provide advisory services. But despite the increase in their accounting fees, the overall net surplus has increased by over $138,000. And that created a profit of $24,000 from a loss of $113,000. And that's all due to the savings made and those couple of strategies put in place. So as you can see, good accounting is definitely worth it. I'm going to be cheeky enough to say that. Okay, your balance sheet, also known as a statement of financial position. It provides a snapshot of your business's financial position at a specific point in time. So it measures the net worth of your business, which is your assets less your liabilities. It also shows your business if your business is solvent. If your liabilities are greater than your assets, then your business is insolvent and urgent action really should be taken to fix this. You can compare different periods to determine whether the business's net worth is increasing or decreasing between the years, and you can track the strength of your business. The stronger your balance sheet, the easier it will be for your business to survive a downturn, just like COVID-19. And it also provides a basis to calculate key business ratios such as debtor days and inventory days, and we'll talk about those a little bit later on. So just on the solvency point, in March 2020, the government's response to COVID-19 included temporary suspension and changing important elements of the Australian insolvency laws. Basically, it involved temporary debt protection, increasing the threshold for statutory demands from $2,000 to $20,000, and a temporary suspension of bankruptcy notices. Now, these temporary changes were due to expire on the 25th of September, However, the government has announced that this period will be extended to the 31st of December. So directors should continually assess their financial situation and take all steps necessary to reduce the immediate risks associated with incurring company debts. If you are concerned about your level of business debt, please discuss with your accountant now. Don't wait any longer. It's important to act quickly. As you can see, the company is currently insolvent as its liabilities are more than the assets. Its working capital is also negative. Okay, so as its current assets here at the top of 138,000 were less than the liabilities of 162. So this means the company cannot pay its short-term debts from the limited cash, debtors and stock that it has on hand. So urgent action really should be taken to remedy this. The business needs an injection of funds of at least 305,000, you can see down the bottom there, which may be in the form of share capital or a shareholder loan to the company. Now, assuming the company can resolve these urgent solvency issues, there are other areas for improvements too. So over the long term, the company could implement strategies to reduce their debtor days and inventory days to increase their cash flow. So to calculate your debtor days, divide your debtors or your accounts receivable, if you prefer to use that term, by your sales figure and then multiply by 35. This will tell you how long it takes your customers to pay you. Now, I measure this every month for my business, and currently this company's debtor days are 26. That means that on average, it takes customers 26 days to pay their invoices. So if this business updated their terms of trade and requested payment within 7 days and managed to reduce, the 26 days by 5, and then, the average collection days are 21, that actually have an additional cash amount available of 13,944. So as you can see, a small tweak can put cash straight into this business's bank account. To calculate inventory days, divide the inventory by the cost of sales and then multiply by 35. Now, not all businesses have inventory, so it might not be appropriate for your business, but we'll go through it anyway. This figure tells you how long the business holds its inventory for before selling it. So in other words, it shows how long your cash is tied up in inventory, and that's really important. This company holds its inventory for 74 days. Now, if they reviewed or updated their inventory processes and reduced the amount of inventory held, they might be able to improve their inventory days by 9, and this would result in a cash flow boost of 7,860. So while these cash gains of nearly 22,000 don't fix the solvency issue, that is another issue that would need to be discussed. It shows that how much cash could be saved with some help from their accountant. So the statement of changes in equity shows what happens to the profits. After you've earned them, what actually happens? They could be paid out as dividends or distributions, or kept in the business as retained earnings and reinvested in the business. It represents the net worth or value of the company, and it's a key indicator of the company's financial health. It also shows whether a company is solvent. Remember, if the company has more liabilities than assets, it's insolvent, and the funds will really need to be paid into the company straight away. The Food Co company has accumulated losses for at least 3 years. This means the company has no retained earnings and is currently insolvent, really. There's no money to pay out as dividends and no money to reinvest into the company to purchase new assets. So the directors really must take action now to increase the profitability and the financial health of the business. And as you can see, we have, just by tweaking the profit and loss account and a couple of accounts in the profit and loss statement, we improved it by 138,000 just doing that. So there are ways to fix this. The shareholder current account records all funds introduced to the business by the shareholders or taken out of the business's drawings or personal expenses. It can help you monitor your personal expenditure from the business, which is important. And for the businesses with more than one shareholder, it maintains a balance of the amount each shareholder has introduced or withdrawn from the business. It shows how much the business owes to the shareholder. If the current account is overdrawn, so it's the other way around, it means the shareholder has taken out more than they've put in and now they owe the company money. To put the account back into a positive balance, the shareholder can repay the loan, or the company can increase its profit to pay a shareholder salary, or a dividend can be declared. So if your shareholder account is overdrawn, it's important to get advice from your accountant as soon as possible to discuss the best options for you and your business, because there are tax consequences for having that overdrawn account, and that's classed under Division 7A, and that's a complicated legislation, so we won't go fully into that today, or we won't actually cover that today, but there are tax consequences for you personally if you owe the money, if you owe your company money. So always address that at the end of the financial year. This shareholder current account shows that at the start of the period, the company owed its shareholder, Mr. Doe, over $29,000. He's introduced $2,000 into the company during the year, but then he's taken out $9,000 out of the company in drawings and life insurance. This means at the end of the period, the company owes Mr. Doe just under $22,000. The amount owed by the company to Mr. Doe can only be repaid if the company is solvent and has the cash available to make that repayment. Also, that repayment to the shareholder is a non-taxable event, so you can always pay yourself back your money that you've lent the business at tax-free. Because in this example, the company is insolvent, Mr. Doe would need to introduce more funds in the company so it's not trading while insolvent, which is really not ideal. To ensure the company will be able to repay the funds introduced, a profit improvement strategy should be implemented so the company becomes profitable. For example, we've demonstrated in the trading account and the profit and loss statement examples of how small changes to processes could result in an improvement of $138,000. And it's definitely not sustainable for shareholders to keep introducing money into the business if it's not profitable. The fixed asset register, also known as the depreciation schedule, records the business's fixed assets such as vehicles, plant and equipment, and facilitates the spread of the cost over the life of the asset. It provides a basis for keeping track of the business assets and can be a useful guide to determine when the assets need to be replaced so they can be budgeted accordingly. I've got construction industry clients that have millions of dollars worth of assets, so this report is particularly important to those type of businesses. It's also useful when selling a business as it records the value of its fixed assets. Now, the depreciation reported in your financial reports, it will in most cases be different to the amount reported on your tax return. And that's because basically with the increased instant asset write-off for small businesses. So don't forget, over the last couple of years, we've gone from 20,000 to 30,000 to $150,000 limit recently. Then after the budget announced this week, it's gone back down to a $30,000 limit. Now that limit was supposed to go down to $1,000 at the 31st of December. So I'm really happy to see that the government has, kept that threshold higher to encourage investment. If the tax depreciation amount is used, so basically if a client has bought, let's just say, a truck and it was $108,000, in the financial statements we would do normal depreciation, but in the tax return he would get the full tax deduction of the $108,000. So if the tax depreciation amount is actually used in your financial statements, your assets are being undervalued in your reports, and this can affect your borrowing power and your business valuation calculations. So just always do a quick check to see that depreciation calculations for accounting and for tax are done separately. So the first column for this fixed asset register lists the name of all fixed assets, and the second column lists the cost of the asset paid on the purchase date. The next column shows the opening value of the assets at the start of the financial year, and this is the cost less the closing accumulated depreciation from previous periods. The next two columns just show the purchases of new assets and disposal of old assets. A disposal could simply mean that the asset has reached the end of its useful life for depreciation purposes and no longer holds any value. So you'll be able to see that in the office equipment with software. It had an opening value of $1. We're showing that as a disposal just to get rid of that because, it's not useful anymore. What have we got? Then we've got the depreciation rate and the method of depreciation used. This company uses diminishing value, which most businesses would use that. For plant and equipment, you would have prime costs on your leasehold improvements, and then that's just set as a percentage and claimed per year at that percentage rate. The next column shows the depreciation for that period. So right down the bottom there, you can see the $45,000 will be the claim on the financial statements. That might be completely different on your tax return. Okay, so if you, especially lately with the $150,000 write-off, if you went and bought your Mercedes-Benz for $120,000, then you might get a full write-off. However, there are car limits, luxury car limits there. And finally, the closing value shows the current value of the asset, and this will be recorded on your balance sheet. All right, so right down the bottom, we're saying, yes, we've got $297,000 as assets in our business. Now, if the accountant used the tax depreciation rates, that could be significantly lower. In fact, that could be zero. So just be aware there. So that sums up the 6 key reports you should be producing and reviewing regularly. Each report tells a different story about your business and assists your decision making in a different way. If you've got any questions about that report section, send them through now and we'll answer them shortly. And then while people are thinking about the questions about the reports, we'll move on to understanding the difference between profit and cash. So how are we going? Are we going good? Have I lost anyone? Have I bored anyone? All right.
I think we're all still here.
Oh, good. Thank you.
And no key questions coming in at this stage.
Okay, all right. I think that's the kind of the driest part of my presentation. The next part is about the difference between profit and cash, and increasing your understanding your business value as well. So it's common for business owners to get really frustrated that their bank account balance doesn't seem to reflect their profits. This is a common question we get asked at the end of every financial year from a lot of clients. So it's essential to understand the difference between profit and cash, and why a high profit business doesn't necessarily result in more cash in the bank account. A profitable business can go out of business because it's starved of cash, and a business running at a loss can survive because it has access to investors or financiers. So in other words, cash flow is every business's reality. We can see here that turnover is vanity, profit is sanity, and cash flow is reality. So to demonstrate the difference between profit and cash, consider these items. So GST, this affects your cash balance. So we can see on the right-hand side, if it affects cash, we'll put it under that side, and if it affects the profit and loss, we'll put it on the other side. So this affects your cash balance, but not your profit, and that's because it's a balance sheet item only. Loan repayments affect your cash balance, but not your profit. So you could have large profits, but because your debt commitments are very high, this could leave you with a small amount of cash. Interest on loans, that affects both profit and your cash balance. Asset purchases only affect your cash balance. Asset sales also only affect your cash balance. And depreciation only affects your profit. So as you can see, even if a business achieved a healthy profit, there may not be enough cash in the bank after paying taxes, making loan repayments, or buying new assets. So the business, the Business 101 cycle is another useful way to demonstrate the difference between profit and cash. So first, the business owners need to invest money into the business. We've all been there and done that. And this money can then be used to purchase the assets needed to run the business. The business may also need additional funding to buy assets they need. So they may take a loan out from a finance institution to make those purchases. These assets are then used to generate a profit, hopefully. Isn't that nice? That's why we're all here. And you can increase your profit by growing your sales or margins, but overhead expenses can drain your profit and result in a loss if they're not managed. So checking your overhead expenses every year is important. The profit then gets turned into cash. Yay, that's what we all want. And then, however, drains on your cash include slow collection of debtors, high inventory days, loan repayments, tax repayments, and payments to suppliers. A business can achieve cash gains, though, by collecting their debtors faster, decreasing their inventory days, negotiating longer payment terms with suppliers, and, of course, the old favourite, reducing tax. The owners then take out cash from the business's drawings or personal loan repayments, and the remaining cash can then be reinvested into the business to purchase more assets and generate more income. So the aim here is to go through this cycle as quickly as possible to increase your return on investment. So after cash flow, business value is the next most important measure of your business success. Now I'm going to say that again. After cash flow, business value is the most important measure of your business success. So part of knowing your numbers is understanding and measuring the drivers of your business value. These drivers might be monthly recurring revenue, revenue growth, revenue per client, total sales, or profit. These will be different for every business, but your accountant can work with you to identify the drivers of your business value. So just as an example for my accounting firm, I actually have a lot of key performance indicators, that we monitor. I monitor everything. Someone once called me, I don't know what they say, you're a Nazi, Suzanne, but everyone loves it. So that was, I'm not sure whether that's a compliment or an insult. But anyway, I do measure a lot, and that just comes with the territory. So we actually measure monthly revenue, our lead generation rate, a number of sales meetings per month that I have, sales conversion rate. Of course, I've got to try and convert as many as I can. The revenue per client is an important one for us. Cash improvement per month, I want that up and up every month. Average hourly rate of revenue and staff productivity percentages. So I actually measure them, I share the results with the team, and then we challenge them. They actually challenge themselves to beat those results every month, and that's been really a great success for us. We have a huge whiteboard on our wall, and I'm happy to share that example with any of you. Just pop in to say, put whiteboard in the comments there. And we huddle around that whiteboard every single morning. We have a thermometer to show our revenue. We've got, dates due for our clients' workload. We've got who's looking after what, and then team goals as well. And we discuss that every single morning, and it's amazing to see. I actually step back, and my team take over those stats, and they're, and we get to the 28th of the month, and they're all hyped up and trying to beat them. So it's actually a real, it's quite inspiring for my team to go through. I would highly recommend that to everyone. So basically, business drivers are critically important factors that determine or cause an increase in the value of your business. Management must understand these key drivers of their business. They should measure them and then fine-tune their operations to run as efficiently as possible. And I highly recommend that you get your whole team involved in choosing the key drivers. You might have a champion for that key driver. Then you should measure them constantly and then analyse the results. So to enhance the value of your business, you must first develop and implement a clear plan and document your organisational structure and roles within your business. That is key here. Establishing real-time cloud-based reporting allows you to make better decisions, and reviewing and documenting your systems and processes ensures your business is running as efficiently as possible. Reducing the reliance on the owners of the business helps to enhance the business value, because it will be easier for any new owner to take over when the business is sold. This is often forgotten by business owners, and they end up building a business that is totally reliant on them. And not only is that not ideal for their lifestyle goals, but it's also not ideal for their business valuation calculations. So I know for me, I'm year 5 here. So at first the business was totally revolving around me, but I can honestly say that, I have a team member that is critical for each process. I can't walk away yet, but I am always evolving my business to make sure that it's not totally reliant on Suzanne. And that could give me a little bit of freedom. I had a day off yesterday. It was amazing. Okay, and finally, identifying and managing risks means that these can be mitigated before they become an issue. Just on the cloud-based reporting point, if you're not already using cloud accounting software, and it doesn't matter what it is, it could be Xero, QuickBooks Online. I mean, I really don't love MYOB. I think it's a bit backwards, but that's just my personal opinion. Then you're really behind the 8 ball here. I can't specify how important real-time information is for business success, especially in this environment. But don't worry, if you're not there, it can be easily fixed with the help of your accountant, and they will help you set it up, and they should offer some training for you as well. Now, unfortunately, even recently, I think it was last week, I've heard of some accountants in the area that still don't support or use cloud accounting. And if that's the case with your accountant, I'm going to dare to say, find a new one. As harsh as that sounds, there's really no excuse in this day and age. Look at me getting all high and mighty. Okay, so as you've seen throughout the webinar, the profitability, cash flow and value of your business all affect you personally. So if your business isn't profitable and doesn't have much cash available, then you won't be able to pay yourself to fund the lifestyle of your dreams. That's what we aim for. But there are a few other things that you can do to protect your assets. And I'll quickly run through these now. Set up your business as a company to limit your personal liabilities. Now, you must seek advice first. A company structure could be involved, but it may not be the top level. So there's family trusts also available or partnerships. But for asset protection, I would say some involvement of a company structure is important. Consider who should be a director of your company and which assets are held personally by those directors. It's important to understand that before you sign up for anything, so we can put protections, policies in place there. Ensure that you have security over any monies you've lent to others, and that includes your business as well. Consider alternative ownership structures for high value assets. For example, if your business owns and operates from a commercial premises that you use, you might consider moving that ownership of the premises to a separate entity like a family trust or even a self-managed super fund. Review your terms of trade and credit policies to ensure you only provide credit to customers who are likely to pay you. Review your insurances, make sure you have some sufficient protection. For example, do you have business interruption insurance, indemnity insurance, and enough cover to ensure the impact of any adverse event is as minimal as possible. Plan for the future. Do you have an up-to-date will, power of attorney, and a clear plan for transferring assets to the next generation? And finally, ensure you undertake financial planning to manage your personal wealth outside of your business. Now, I'm a little bit excited because we at ClearPath Accounting are actually investing in some technology that will allow our clients to view their personal wealth with the one click of a button. So this will help us view the personal financial goals of our clients, which will then help us to understand what their business needs to deliver to achieve those goals. So I've got a client, he's 31, he says he wants to financially retire at 40. So having those eyes to his personal financial situation, although we are not financial planners, that just gives us the basis to see, what his business needs to achieve and by when. And then we push hard every month. Now, this list is not exhaustive. These are they're just some ways that you can protect both your business assets and personal assets. And your accountant, your financial planner, or your lawyer can all help to identify specific ways you can protect your assets. So please discuss these items with the experts, I say. So how does everything I've talked about today come together as best practice? Every business should use 3 essential tools: an annual business plan, or in these times, a business recovery plan. If you've had a particularly harsh shutdown from COVID-19, a business recovery plan might be more appropriate. Start with a short plan, keep it fresh, and regularly update it. You'll need to be fluid in these times. In fact, our Vice President Anil from Chan & Naylor Business Coaching and Justin from Chill IT, they're presenting a webinar on the 29th of October as part of this Small Business Month webinar series. So if you're interested, make sure you sign up for that. So it's all about planning. The second essential tool is an annual forecast. Then use it to measure your results against your expectations. This will allow you to make changes as soon as you find out that things are not going to plan. Ongoing reporting and accountability. The reporting ensures that the numbers you want to achieve in your plan and forecast are being measured. The accountability process is some form of coaching. Use an independent coach to hold you accountable. You'll actually be amazed by the results. This can be your accountant, if they're good, or it can be a business coach like Anil. For me, personally, I have a business coach, and coaching was the one essential thing that helped me to excel results and speed up my business growth. And it's helped me maintain my sanity while doing so as well. So knowing your numbers is really just the beginning. It allows you to improve them and ultimately achieve your goals in your business. So where to from here in these challenging times? Hopefully you'll take what you've learned today and implement some positive changes in your business. Now it's time for you to decide what you're going to do. Take a few moments after this webinar to write down 2 or 3 actions or projects that will add value to your business. So think about what problems that you're experiencing in your business at the moment, identify these problems and use them as an opportunity to create a project to fix them. Doing nothing, I say, right now should not be an option. And just as a final note, the information in this educational webinar is general in nature and does not substitute for specific tailored advice and support. So by working with you one-on-one, your accountant will be able to identify the most important actions to take that will make the biggest impact in your business. If you feel you're not getting that support from your current accountant or advisor, then I do recommend that you seek the services of a more engaged accountant to help you. It's important that every business owner, especially in these times, has this level of support. Please feel free to contact me or my team should you have any questions, or if you'd like to set up a complimentary appointment to see how ClearPath Accounting can help you. Our contact details are on our website at www.clearpathaccounting.com.au, or you can contact the Chamber to get our details. So thank you so much for joining me. I'll just put on my video. How are we going, Greg?
All good. Thank you, Suzanne. That was terrific. I'm sure that everybody was very engaged and there was a lot of information. There was a lot of info in that presentation.
It really is. And your handout will have some examples in there. It'll show, it'll just reiterate the information in that webinar. It is a heavy content webinar. I don't know how to make it any less. But I'm very passionate in making sure that all of our clients understand their numbers, because basically, as I said, that is the beginning, really. Then we can tweak as much as we like, and we move the, the dial every single month.
Yeah, that's great, Suzanne. So thank you. We've got a question from Gordon, who appreciated the session first of all, but he's also asked about cash flow and was interested that wasn't in your top reports. I think, Gordon, if I haven't quite expressed that correctly, feel free to.
Cash flow forecast, yeah, okay. So generally that is not generally that's a separate report to your financial statements. I believe that cash flow analysis, cash flow forecast should be done for every business every single year. This is critical. You'll be able to tell from that type of report, and yeah, that's a good point. Thank you for adding that in. You will be able to determine which months you're going to have a cash deficit, if ever, and then where would you, and plan to find where would you find that money. So that's a really good point, Gordon. Thank you for bringing that up. But I totally agree with you. It's not really presented in the financial statements of your accountant, but it is an important service or report that every business should do every year.
Thank you. There's no other questions in the chat, but folks, you should be able to unmute yourselves now if anybody would like the opportunity to ask Suzanne a question. Lots of positive comments, so I'll just keep an eye on that. But overall, Suzanne, thank you for sharing your knowledge and experience. You've got a lot of it, and we can see your enthusiasm coming through as always, which is great. Personally, it was helpful to me. I'm not financially literate, although I've survived 13 years in business somehow. But the other thing that I really appreciated was and I'm a bit biased, but your comments around including the team in sharing the targets and sharing the results and seeing that as something that we do together. I think is really.
I think there's a lot of uncertainty. Yeah, there's a lot of uncertainty with business owners. Should I share my full situation?
Yeah.
Having a new business 5 years ago for me, you know what, I just opened everything up to the team and I said, this is where I'm at, literally the bottom. And then we would just monitor that. And there's a lot of enthusiasm created in the team. They appreciate that I'm not hiding anything. They know my full, honest financial position at all times. We celebrate together, and then if we don't meet a target or something needs to be reviewed or checked or changed or improved, they are 150% behind me all the way. I am very lucky to have a team that I do. Yeah, but I do recommend it. And if you find that your team members are not the people that are going to back you, I'm going to say you have got the wrong team members.
Yeah.
Geez, I sound harsh today, don't I? But I totally believe that.
Yeah. No, look, I'm an advocate for that as well. So good on you. So final opportunity for questions, folks, before we wrap up.
Comments, whatever. Chat.
Okay. I think
all right.
that's been great. Just a final note, folks, there will be a recording available of this, so we'll get that up on the Chamber website and get a link out to you somehow. If you haven't got the access to the information that Suzanne sent out before the session, please do let us know, because there's some great stuff in there. And just a final reminder about the 3 further sessions through the Chamber celebrating Small Business Month. Social media with Simon Gould is our next session next Thursday. Then we've got Unlocking the Potential of Your Team with myself on the 22nd.
Hey, Greg.
I think that is. And then, thank you. And then Planning to Future-Proof Your Business with Anil Puri and Justin Melton. So be sure to get onto the PVCC website and book for those further sessions. If you're not already a member of the Chamber, I think most of you are that are joining us today, but if you're not a member of the Chamber, please consider doing so. Hopefully you've seen today a demonstration of value that can be added to your business through your Chamber membership. Other than that, thank you for joining us, folks, today. Thank you particularly to Suzanne, of course, and have a great day, everyone.
Yeah, and from me, thank you for attending the webinar. I know people's time is very valuable, and I appreciate it. Again, if you've got any questions, if you want to have a private conversation with me about a particular question, please just put your email address in the comments, and then I can contact you. If you're interested in finding out more about Clear Path Accounting and how we can help you, go to our website. We've got all the information in there. We can, send us an email, and then we'll contact you. And we hope that we've given you plenty of ideas to ponder and some clear next steps for you and your business. So thank you.